Everyone tells you to buy the dip.
Think you want to be buying the dip?
Retail investors this week have kept buying despite the market conditions through the dip.
Buying on the dips might be a good idea.
Individual investors have been buying the dip.
But what if that single piece of advice, the one everyone repeats, is actually the reason most traders keep losing money? Over 10 years of trading full-time and more than $1 million in verified payouts, I've learned that buying the dip isn't always the move. Sometimes it's the exact moment the market takes advantage of you, because not every dip is a discount. Some are designed to trap retail traders right before the next drop. In this video, I'm going to show you why buying the dip can actually cost you money and introduce you to the one factor that professional traders use that almost nobody talks about: seasonality. You learn why markets move in rhythms, not randomness, how time itself shapes price, and how understanding the seasonal tendencies of a market can turn what feels like a chaos into structure and structure into probability. By the end of this video, you will know the exact lessons that helped me generate the $1 million in verified payouts, and why mastering this one concept changed everything about how I trade. But before we get into seasonality and how it actually works, I want to start with the one truth it took me years to accept. You don't know what you don't know. Lesson 1. You don't know what you don't know. When I first started trading, I thought the goal was to outsmart the market. I spent hours staring at charts, looking for that one pattern or indicator that would finally make everything click. I was confident but blind. The truth is, I didn't even know how much I didn't know. And that's one of the most dangerous places to be. Not because you're wrong, but because you're unaware. It's like learning to fly in a simulator. You feel in control. You press buttons, you take off, everything works until the first time you face real turbulence. That's when you realize the difference between knowing how something works and knowing how to survive when it doesn't. Trading is the same. When you start, it feels simple. Buy low, sell high. But then you discover the market doesn't care what you think. It only rewards structure, discipline, and understanding how all the pieces fits together. At Online Trading Campus, we teach that you can't trade with confidence until you have built a complete trading ecosystem where fundamentals build your bias, and technicals define your timing, and discipline ensures your execution. Your fundamentals aren't guesses or news events. They are measurable data, and we have our 3 core tools: the CUT, Commitment of Traders Report, the Seasonality Indicator, and the Valuation Tool. They help you understand why the market moves before you ever think about when to trade. Back then, I didn't have any of that. I was reacting, not planning. And guesswork in trading has a 100% failure rate. Once I accepted that, everything changed. Because the moment you realize you don't know everything is the moment you finally start to learn what actually matters. Lesson 2. The market has seasons. Every market breathes in cycles, just like nature. It moves through seasons of growth, slowdown, and reset. Some traders think price moves randomly, but the truth is, it often follows time-based behavior. That rhythm is called seasonality. Seasonality isn't about predicting the future. It's about recognizing probability based on repetition. Think of it like the change from summer to winter. You don't wake up one morning surprised that it's cold. You knew it was coming because it always does. It might arrive a few days early or late, but the shift is consistent enough to prepare for. That's how professionals treat markets. When you understand which seasons favor buying and which favor selling, you stop chasing random setups and start aligning with natural market rhythm. It becomes less about reacting and more about anticipating. Our seasonal indicator visualizes exactly that, showing how price has historically behaved month by month over the last 10 to 15 years. If a market has dropped during the same period 12 out of 15 times, that's not luck, that's probability. And that probability gives you context. Once I started using seasonality, trading stopped feeling like chaos and started to feel like physics, like cause and effect, timing and probability. It taught me that markets, like people, have habits. And if you can identify those habits, you can trade with them instead of against them. Now, let me show you what that looks like in real time. Seasonality in action. Now, let's see how seasonality actually plays out here on the charts.
So here I'm on Trading View. We are looking at a product, at a market that everybody knows and everybody likes to trade, gold futures. And I'm going to show you, this is a 10-year gold chart, a daily chart, and I'll show you a 10-year seasonal pattern here, and also obviously then a forecast of gold, a seasonal forecast. So today, when I'm recording this part, is the 15th of November. So I'm going to show you a forecast for December. So you can be excited about that. So a very specific seasonal pattern is the December, the end of the year, or sometimes even called Christmas rally. I mean, it lasts even longer than just Christmas, but let's call it the end of the year rally. And down here, you see below the chart, there's our own proprietary OTC True Seasonality indicator. It's not like any other conventional seasonality indicator. It's actually very dynamic. It changes its forecast because it's not calculated based on calendar days. It's calculated based on trading days. And this makes a huge difference, ladies and gentlemen. So we start back in 2014. During that particular time frame, as I said, looking into November, end of November, beginning of December, into actually mid to end of January. And down here, you always see basically what our tool would have been forecasted. Obviously, like a lot of tools, or like most of the tools or any tool, it's not always correct. But it's kind of, as you will see, it's very, very accurate a lot of times. So here in 2014, you see basically from December, starting from end of November to December, into end of January, you saw a rally in price. And even the tool forecasted that. Now next year, 2015, you see again from December into end of January, you see even longer, but you see we are closing much, much higher. And even the tool forecasted that rally. Now we are looking into 2017 here. And even in 2017, you see the tool forecasted first a little bit continuation of a drop, but then starting a rally. And also here, we saw that December, January rally into February. Now in 2018, so 17 into 18, you see even here, the tool forecasted that nice rally. And also here we got this nice rally starting literally almost from, December into end of January. Now in 2019, 18 to 19, you see the tool forecasted, and that's why I'm saying it's not always accurate by the day. It's impossible, obviously. It gives you an indication when we have like the most recent bottoms or tops. Also here, you see, well, it forecasted a rally from mid of December into end of January. Here we started the rally already earlier, but also like, as you see, from December into end of January. Now from 19 to 20, same scenario you see every time so far. Looking into 14, 15, now we are in 20. From December to January, we are getting this nice rally in price, and even the tool is forecasting it. Now here you see, and this is when I say it's not always correct. Now in 20 to 21, you see now it forecasted first a drop and then a rally, but look here, it actually rallied and then it actually dropped. So although we started that rally, that December rally, like all the years before, we then started to drop where the tool said, hey, we continue to rally, but here it didn't happen. All right, so as I said, it's very accurate most of the times, but it's not a holy grail. And then you see 21 to 22. Also here, we see first flat forecast and then a rally. And also here we see a December rally. We see that December to end of January rally. And you can do this backtesting obviously by yourself as well. And then we have 2022 to 2023. Even here, you see here very accurately, a little bit flat, and then we start this rally. And also here we have this rally, that December rally on gold. You see, this cannot be a coincidence that every time in December, in January, you are bullish on gold, on the gold or not. You should be bullish on gold, but you see basically that price is rallying. And you see now, as I said, it's not always accurate because also now, and the only time you see that here now, it's interesting, in the past 10 years, there was only one time where there was no December rally, or call it December into end of January rally. You see here, this was actually only last year. All the previous 9 times you had this massive rally, as you saw, because here the tool forecasted a strong rally or rally from beginning of December, but you see price was flat and the rally started actually 1 month later, end of January, so February, March, super strong. All right, and you can guess now what the tool itself, because these are forecasting tools and we consider them fundamental tools, right? Why are they fundamental tools? Because they are not lagging. They don't need, this tool doesn't need price to move first, and then it's not a technical indicator that needs price to move first, and then it's going to move afterwards. So you see here a clear price forecast. And when you look just by the tool, and I'm going to use now vertical lines, it says that we have a bottom around end of November, and we have another bottom. Let me do this here, clone it. We're gonna see another bottom around, you see, the Christmas time. Before Christmas is a very bullish time here on gold, and then we're gonna go straight up, you see, into end of January, into February, right? So that's a 60-day forecast from today, which is weekend. So as I said, it's the 15th of November. Now, very important. So this gives us, as I said before, an indication of when the bottom might occur. It's not a timing tool per se. It gives us an indication.
Lesson 3. Why the dip isn't always a discount. Everyone loves the idea of buying the dip. It sounds logical. Prices fall, you buy cheap, they rise again. But in trading, what feels logical often isn't profitable. Here's what really happens. When price starts to drop, retail traders rush. They see a red candle and think, perfect, this is my discount. But the market isn't a supermarket. It doesn't hand out sales. It hunts liquidity. Most of those dips appear when larger players are offloading their positions. They push price lower to trigger retail fear, creating volume and fill their orders on the other side. So while you're buying what looks cheap, institutions are quietly selling into your excitement. And when a dip happens during a seasonal weak period, the odds stack even further against you. Because now you're fighting not just the short-term order flow, but a time-based tendency that repeats almost every year. You're buying in a season where selling pressure has historically dominated. That's why buying the dip without context becomes a trap. It feels right in a moment, but you're stepping directly into the part of the chart designed to take your liquidity. The professionals think differently. They don't just ask, has the price fallen enough? They ask, is this decline part of a larger seasonal cycle? If it is, they wait, because patience often pays more than prediction. So next time you see that tempting dip, remember, cheap doesn't always mean opportunity. Sometimes it's the market inviting you into a position it already plans to reverse against you. Lesson 4. Strategy focus. Aligning seasonality with supply and demand. So let's put this into practice. is. Because understanding seasonality is one thing, but using it to make better trading decisions is where the real edge begins. If you've ever wondered why your perfect looking setups keep failing, this is usually why. You're trading against time. Every chart has two dimensions, price and time. Most traders only analyze price. Professionals analyze both. Because when you combine where the market is moving with when it tends to move, you create alignment. And alignment is what turns probability into profit. Here's how I do it.
Now, to add supply and demand. Now, we have two more. As you know, I'm using two more fundamental indicators, which is the CUT report and the valuation model. And when it comes to valuation, I would compare gold versus 30-year treasury bonds and gold versus the dollar. And I want to be, during that particular time, I want to be ideally undervalued as well. And when it comes to CUT, now it doesn't make sense to look at CUT. We are, as you see, 2 weeks before the before a potential low, or actually even a month before another potential low. So, and CUT, since we had also the government, quote-unquote government shutdown, there was no release of the CUT report in the past few weeks. So it's really not necessary right now to look at CUT. But I just give you an indication what I would like to see when it comes to during that particular time. I would like to see the commercials, the smart money being more bullish than before in relative terms, and maybe also the icing on the cake, I would like to see the retailers being more bearish than before, so in relative terms. However, if they are neutral, if the CUT is neutral, I would take this trade based on seasonality only. However, CUT, if the commercials were really, really bearish and the retailers were super, super bullish, then you have a contradictive picture, a contradictive story, and then CUT, since CUT is more powerful, then CUT would overrule seasonality, but only if the commercials are super bearish and the retailers are super bullish. Otherwise, we would trade that seasonal pattern no matter what. Now, to add supply and demand, as you know, we have that CIF process, which is like we need to be covered, it has to be a nice imbalance, and the zone has to be fresh. Now, if we do like weekly income, we would look first at the weekly chart, and we would need to find a nice weekly demand zone. So since we don't have any kind of weekly demand zone here, this is not a demand zone, the next weekly demand zone, as you can see here, is only basically here. All right, it's only here. Here's the demand zone. Let me just make this. Here. All right, so we have a weekly demand zone. Unfortunately, there's no other weekly demand zone earlier. So the question is, are we really going to come down here? All right. Good. Now we would need to look into daily and find a daily zone within that weekly. And as you can see here as well, they are strong. Now I remove that again. So you see that's the weekly. So we need to be covered, right? We need to be covered. And you see here, there's a very nice daily demand zone. Here we would do like here and here. Right. You know, here, to be honest, since we have, and I would do on that gap, because here we have a gap. See, here we have a gap. So I would wait for that gap to be filled and then start my proximal line. Since though we have here a clear level on top of level, here, although this lower level is below the weekly, but I would still consider it important. I would highlight both and play it as a level on top of level. So most probably either combine both levels, because you see that's a rally that might last long into February and March, or trade only the lower one, but most probably here. I mean, it's still time combine these levels, right? Because they're also close by. Now, the question is, will price come all the way down here? Well, this is something we don't know yet, but we have also, you see, nice daily demand zones just above. So what we can do is we could trade gold daily income, which is then basically we look at the daily chart. We look at the daily chart and highlight the daily demand zones. This is tested, but again, this is now our high. This is now our higher time frame zone, and then we would go into 4 hour and find 4 hour zones. And you see here, it's actually also level on top of level. It's almost overlapping. So I highlight the combined area. And now we could go into the 4 hour chart. And you see here, in here we need to find something that is covered, that is fresh, it has a nice imbalance. You see you have here a really strong demand zone. Here is one. See, here's a very nice zone. And then below you see you have also a very nice zone. And I highlight that for you. And again, I want to stress that that's the process, right? So we are looking into seasonality first as one of our fundamental tools to get bias, to trade a market that has seasonal tendency during a particular time. And gold, as you can see, is very, very seasonal during that time. And you can do that back testing yourself. So if the other two tools like CUT and valuation confirms that seasonality for that particular year, well, then it's like an all-stars aligned trade or even an A+ setup, however you want to call it. And you see here now you have the 4 hour chart. So this would be daily income, and down here would be weekly income so far. We don't know what's going to happen in the next few weeks, but so far that's the status quo. And guys, if you want to have some updates on that gold trade, please leave a comment down below, and I can make some update videos on that. So thank you for watching that.
That's what professional trading looks like. Structured, patient, and data-driven. It's about planning trades, not finding them. When you integrate seasonality into your supply and demand strategy, you stop fighting randomness and start trading rhythm. And that one adjustment, adding time to your process, can dramatically increase your edge and consistency. Because when price and time agree, you're no longer guessing, you're aligning with probability. Lesson 5. The trading ecosystem and your edge. A complete trading system isn't just a strategy, it's a needed process. And that process is what separates lucky trades from consistent performance. At Online Trading Campus, we call this process the trading ecosystem. It's the foundation behind everything we do. It has 3 parts that work together like gears in a machine. First, fundamentals. Tools like the CUT report, seasonality indicator, and valuation tool. These build your directional bias and give every trade a purpose. Second structure, your supply and demand zones, built using the CIF filter, cover, imbalance, and freshness. This defines where you trade and when you act. And the third, execution, your discipline in managing risk, setting alerts, and using a set and forget approach to remove emotion. That's what protects your edge over time. Most traders skip the first and the last. They focus on entries, ignore bias, and trade emotionally. They build a house without a foundation and then wonder why every storm wipes them out. The more I traded, the clearer it became. Edge doesn't come from one good setup. It comes from how all 3 parts of your ecosystem work together. Every day, every trade, every season. That's why your real advantage isn't speed or prediction. It's time, context, and consistency. Because when your system takes care of the process, you finally stop chasing results and start repeating them. Lesson 6. Time, experience, and payouts. People often ask me, how long did it take you to become consistent? The honest answer is years. Every one of these payout certificates represents a chapter in that journey. Not a moment of luck, but a milestone of growth. When I look at them now, I don't see money, I see time. I see thousands of hours spent studying charts, refining systems, reviewing trades, and learning patience. None of it happened overnight. It came from building, testing, failing, refining, season after season. Each mistake became data. Each data point became experience. And that experience became consistency. Because trading isn't about having a good month. It's about surviving the bad ones and still being there to trade the next season. Most traders overestimate what they can achieve in a year and underestimate what they can achieve in 10. These payouts are proof of that. They are a timeline of work, discipline, and trust in the process. They remind me that compounding doesn't just apply to capital, it applies to knowledge. You don't grow through one big breakthrough. You grow through 1,000 small improvements stacked over time. That's why time in the market will always beat timing the market, because skill, like equity, compounds. I'll make another video in the future showing exactly how that compounding looks and how experience, patience, and data keep building on each other year after year. So, if you take one thing away from this video, let it be this. Markets aren't random. They move in rhythms, in seasons, in cycles, in probabilities. The real difference between retail and professional traders isn't how many indicators they use. It's that professionals know when not to trade. Because consistency doesn't come from predicting every move. It comes from knowing when to wait and having the patience to do nothing until the odds are in your favor. Once you align your plan with time, you stop forcing trades and start following flow. You begin to see that real success isn't found in constant activity, it's found in disciplined continuity. You don't have to catch every move, you just have to be present when it's your season. If you want to take this a step further, go watch the #1 rule to actually make money trade. In that video, I break down exactly how to turn this patience into a practical rule. The same principle that keeps professionals consistent year after year. Keep learning, keep refining, and remember that patience pays more than prediction.